Since the early 2000s, the number of households in the private rented sector has roughly doubled to around 5 million in Great Britain. However, in recent years, the number of rental properties listed has been falling. And this mismatch of rising demand and a shortage of supply is a key factor behind rents becoming more expensive. Since 2021, listings have declined and rents have risen by 30%. Yet, whilst domestic amateur landlords are leaving the market, they are being replaced, at least partly, by big foreign private equity and corporations. There's also been a rise in build to rent, which tend to be owned by large corporations, and over half of the capital investment comes from abroad, in particular US private equity. However, whilst a new build to rent is welcome, it's not replacing the net loss of properties, which according to Savills is much greater. And this really does leave an uncertain future for private renters, who can be paying over 32% of their income on housing costs, a sharp contrast to homeowners who typically spend a much smaller share. And with house prices on average 8 times income, an increasing cohort of young people face renting for life. But if rents have risen 30% in a few years, why are private landlords pulling back from the market? There was a time when buy-to-let was seen like a license to print money, and certainly those who bought houses in the mid-1990s or even mid-2000s will have seen rapid capital gains which far exceeded any inflationary impact. Not only that, but there was favourable tax treatment. Landlords could even claim mortgage interest relief. But all this is going into reverse. The share of buy-to-let mortgages is unmistakably falling. Successive government legislation has removed tax advantages, increased the rate of stamp duty, and also introduced new regulations which are swinging the balance more in favour of renters. The new Renters Charter, which will be implemented later in the year, early 2026, will also further strengthen the position of those renting, but increase costs for landlords and possibly reduce supply even further. According to a survey by buy-to-let lender Lindsay, 16% of landlords say they will sell all their properties if the bill goes through. In theory, that means 750,000 properties dropping out of the market. Now, I would be sceptical of that figure. We've been talking about a mass exodus of landlords for quite a few years now. However, the statistics do show a steady decline in that buy-to-let market. The age profile of landlords is also quite high. Many who bought 10 or 20 years ago are sitting on capital gains and with more hassles to let, may well take the decision to sell up and finance their retirement. There is a certain logic for many landlords approaching retirement age. The impact is that more houses are coming onto the market for sale, which will keep a lid on house price inflation. Good news for first-time buyers, but not good news for those in the rented sector. Now, it is worth bearing in mind that generation rent is an increasingly influential political force, with around 11 million people living in the private rented sector. Generation rent has increased pressure to loosen planning regulations, the YIMBY voting bloc, but also been a key in strengthening renter rights and pushing for rent controls. Also, the decision to extend the vote to 16-year-olds and also automatic vote enrolment will also increase the political salience of renters even more. In 1991, 40% of households were owned with a mortgage and just 10% private renters. But today that gap has narrowed sharply, a big shift in the composition of UK households. Now, ever since 2021, there's been a strong net balance of landlords who say they are planning to leave the industry. And a combination of factors are making it less attractive to stay there. Firstly, buy-to-let properties now incur an additional 3% stamp duty surcharges. So for houses over $250,000, investors will face a marginal stamp duty rate of 10%. That's a really big cost for buying a second house. Now, in the past, a landlord could perhaps have relied on rising house prices to recoup this kind of loss. But with a housing market stretched with high price-to-income ratios, the likelihood of big price rises, the kind of what we saw in the 90s and early 2000s, does seem quite distant. Because after the temporary COVID boom, when interest rates were near zero and the bank introduced a new wave of quantitative easing, house prices soared temporarily. But since we've had rising mortgage rates starting in 2022, a reversal of QE, that's taking away the sugar rush of cheap mortgages. And adjusted for inflation, house prices are lower than 2022. In fact, real house prices are still lower than 2007. So if you're looking for capital gains, the housing market is far from the one-way bet that it seemed to be in the past. One interesting observation is that as buy-to-let mortgages fall as a share of the market, there's been a rise in first-time buyer mortgages, and this is perhaps helped by lower stamp duty rates for first-time buyers, and also a weakening of mortgage restrictions introduced after the financial crisis, which will once again enable higher income multiples. Also, because private renting is so expensive, it encourages people to try really hard and buy wherever possible. So if a buy-to-let investor is asking whether housing is a good capital investment, it would be really hard to get infused by that prospect. Despite falling house price inflation, the ratio of house price to incomes is not far off record levels. Affordability is still very stretched, and also with very low economic growth and low income growth, it's hard to see a big, strong growth in demand, and therefore prices will be muted to say the least. Now, Savills offer a speculative 5-year forecast of 23% house price growth, the OBR just 13%. No one really knows that far in advance, but once you account for inflation, even optimistic forecasts offer little impressive capital gains. Certainly after costs and tax, it's hardly something to get excited about. Now, in addition to the prospect of stagnant real house prices, many landlords will face higher costs. Firstly, just the usual wear and tear repairs have become more expensive since 2021 due to the effect of inflation. But also the new rental legislation includes an end to Section 21 no-fault evictions, new licensing and safety checks. The Renters Reform Bill also gives tenants stronger rights to challenge rent increases, new rules around deposits, and making sure that the advertised rent is the one that renters will pay. Also, for some landlords with older properties, the requirement to bring up houses to environmental EPC grade C from 2028 could be very expensive. The UK certainly has a high share of old, drafty properties, but improving the insulation will be quite expensive. But if the buy-to-let dream is over, who is going to be renting properties to the 5 million households in need of renting? Well, the big change is that private equity is getting involved in buying up properties for rent. According to Savills, private equity bought 5,000 homes in the year to September, up 20% on the previous year. Now, this sector has largely been driven by private equity, large institutions such as Lloyds and Legal & General. And in this regard, the UK is really catching up with global trends. Currently in the UK, just 3% of rental homes are owned by institutional investors, compared with 37% in Germany and 41% in the US. But this low rate is going to change in the coming years. Blackstone, the world's largest real estate investor, has bought around 4,500 rental homes from Vistry since late 2023 in deals worth 1.4 billion. I expect to see a lot more of this coming along. Now, private equity see the rental market as a strong, profitable business, and they're less concerned about short-term capital growth. They're in it for the long haul, and they certainly don't have to buy with mortgages. They have huge reserves of capital to invest. Now, what will be the impact of this on the rental sector? Well, it is a bit uncertain, but they're not in it out of charity. Now, according to UK Finance, the average UK rental yield at the start of 2025 is 6.94%, with average buy-to-let mortgage interest rates of 5%. And this is higher than the rental yield of, say, 2017, when the rental yield was around 5%. But also now, mortgage rates are also significantly higher than that year. So, very slim profit margin. There's also, of course, a regional variation, with the best rental yields in those areas of the cheapest house prices, like the North East and Scotland, and the lowest rental yields are in London and the South East. So for any potential buy-to-let investor, it really isn't a particularly attractive option at the moment, unless you're very skilled in doing up properties or finding a bargain to do up. But this does leave the rental sector increasingly reliant on private equity and this new type of institutional investor. And although you can understand why renters want better rights and protections, there is a concern that the worst thing to happen it will be a further fall in supply, which only increases prices further. Now, it is possible that interest rates may fall later in the year and into 2026, although with inflation being a bit more persistent than the bank would like, there may not be too bigger cuts coming. This video goes into more detail about whether interest rates will fall, and if they do, by how much. Thanks for watching, and see you soon.